In this module, we shall study about valuation of assets and liabilities. Section 129 of the Companies Act 2013 lays down the financial statements shall give a true and fair view of the state of affairs of the company or companies, comply with the accounting standards, and the format of those financial statements shall be as per Schedule 3rd of Companies Act 2013. It means all matters which affect the financial position of the business have to be disclosed. No secret reserves are to be created. The assets and liabilities have to be properly valued so that the balance sheet discloses the true and fair position of the business. The present chapter deals with the different principles involved in the valuation of different types of assets. After studying this module, one shall be able to first define the term valuation, second understand the concept of assets and liabilities, third understand the provisions of valuation of assets and liabilities. Let us understand the meaning of valuation. Valuation is the process of estimating what something is worth. Valuations can be done on the assets. For example, investments in marketable securities such as stocks, options, business enterprises, or intangible assets such as patents and trademarks, or on liabilities, example bonds issued by a company. Valuations are needed for many reasons such as investment analysis, capital budgeting, merger and acquisition transactions, financial reporting, taxable events to determine the proper tax liability, and in litigation. Valuation is the act of determining the value of assets and critical examination of these values on the basis of normally accepted accounting standard. The valuation of the assets and liabilities are made by the proprietors or officials of the company or the firm. We shall now discuss the meaning of assets. According to the Institute of Chartered Accountants of India, the term assets refer to tangible objects or intangible rights owned by an enterprise and carrying probable future benefits. Next, classification of assets. For valuation purposes, assets can be classified in the following categories. First, fixed assets. Second, current or floating or circulating assets. Third, wasting assets. Fourth, intangible assets. And fifth, investments. Moving on to the methods of valuation of assets. Valuation of various assets can be made by using different methods. The principles regarding valuation of each of the above categories of assets are being discussed in detail. A. Valuation of fixed assets. Fixed assets represent assets held with the intention of being used for the purpose of producing or providing goods or services and are not held for sale in the normal course of business. It deals with plant and machinery, land, building, furniture and fittings, motor vans, etc. In the books of accounts or in the financial statements of the business enterprise, fixed assets shall be recorded either at historical cost or at revalued price. Next, historical cost. This is the ultimate cost or final cost of acquisition of asset after capitalizing all related expenses, which includes following things. First, when asset is purchased, A. Actual purchase price of the asset, B. Excise duty, import duty and other taxes only when it is not refundable taxes or when CEN-VAT, CEN, VAT credit or input credit of such taxes are not available to the assessee. C. Any expenses or cost related to this asset to bring it in working condition. In other words, it can be said that any expense up to the date when asset is put to use, freight, loading and unloading, installation, etc. Second, when an asset is self-constructed, A. If asset is constructed in-house and not purchased from the outside market, it is called self-constructed asset. Cost of such asset shall include following. B. Any cost directly attributable to the asset. C. Any common cost or expense for construction of such asset should include after making proper allocation between the assets to which it relates. D. If any internal profit included in normal course of business should be reduced or not to include in cost of asset. Third, asset is required in exchange of existing asset for non-monetary consideration. A. If fixed assets exchanged are similar, fixed assets acquired should be recorded at fair market value of assets given up or fair market value of assets acquired. If this is more clearly evident, or net book value of the assets given up. B. If fixed asset acquired in exchange of share or other securities, assets should be recorded at either fair market value. Next, special cases of valuation of asset. First, in case of hire purchase transaction, asset should be recorded at its cash price. Second, fixed asset is acquired at consolidated price, then cost of each fixed asset shall be determined on fair value basis by competent valuers. Third, in case of jointly held assets, either the original cost, accumulated depreciation or written down value should be stated in the balance sheet, or pro rata cost of such jointly owned assets is grouped together with similar fully owned assets. B. Valuation of current assets. Current assets refer to assets which have been acquired with the intention of converting them into cash during normal operating cycle of the business. It includes cash including fixed deposits with banks, accounts receivable, that is debtors and bill receivable, inventory which includes stock of A. Finished goods, B. Stores and spare parts, C. Raw materials, D. Work in progress, E. Advances recoverable prepaid expenses, that is cost of unexpired services which have been paid for in advance. The important principles involved in the valuation of specific assets are being given below. First, cash and bank balance. The only principle involved in the valuation of cash is to physically count the cash at the disposal of the business and express it in terms of its face value. As regards valuation of balance at bank, it will be appropriate to obtain a certificate from the bank in respect of the balance which the business with the bank. Such balance may be reconciled with the balance as shown by the cash book by preparing a reconciliation statement. Second, accounts receivable. The accounts receivable, that is debtors and bills receivable, should be valued at their realizable value. Realizable value of the receivables can be ascertained by deducting the bad debts written off and provision made for possible doubtful debts from the actual amount due. Third, inventories. Valuation of inventory is done on the basis of cost or market price, whichever is less. C. Valuation of wasting assets. Wasting assets are those fixed assets which are depleted gradually or exhausted in the process of working, such as a mine, oil and gas deposits, standing timber, etc. However, there is a difference between the decrease in the value of fixed assets and a wasting asset. In the case of the former, the decrease in its value is due to wear and tear or obsolescence, while in case of the latter, it is due to operation of extracting a part of it and selling it out or due to exhaustion. It is difficult to determine the extent to which a wasting asset is exhausted. Only a rough estimate can be made about the extent of its exhaustion. The wasting asset is therefore valued at its cost less the amount of depletion based on the estimated exhaustion of or extraction from such asset. D. Valuation of intangible assets. Intangible assets are those assets which cannot be seen or touched. Example, goodwill, copyright, patents, trademarks. Accounting Standard 26 Intangible Assets lays down the basis for valuation of intangible assets. The intangible assets have to be valued at cost less any amount amortized. When intangible assets are acquired by purchase individually or as part of total purchase of business, the determination of the cost of intangible asset is similar to the computation of cost of plant and machinery or any other asset under similar circumstances. However, when intangible assets are acquired by self-development, the computation of their cost involves a number of difficulties on account of the necessity of apportionment of joint cost on a suitable basis. E. Valuation of investments. Investments are assets held not for operational purposes or for rendering services, that is, assets other than fixed assets or current assets. Accounting Standard 13, Accounting for Investments, provides the basis for valuation of investments. Current investments should be valued at cost or market price, whichever is less. However, long-term investments should be valued at cost. In case of a permanent decline in the value of such investments, adequate provision should be made out of the profit and loss account. Let us understand the meaning of liabilities. According to Institute of Chartered Accountants of India, liability is the financial obligation of an enterprise other than owner's funds. A liability is a present obligation of the enterprise arising from past events, the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefits. Next, classification of liabilities. Liabilities may be classified into current and non-current. The distinction is made on the basis of time period within which the liability is expected to be settled by the entity. IAS 1 states that liabilities are to be classified as current if any one of 4 specified conditions is met. The conditions are: A. It expects to settle the liability in its current operating cycle. B. It holds the liability primarily for trading. C. The liability is due to be settled within 12 months. D. It does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. All other liabilities are to be classified as non-current liabilities. The following are a few of the current liabilities that can be seen on the typical balance sheet: accounts payable, notes payable, income tax payable, wages payable, accruals, accrued expenses. Long-term liabilities that can be seen on the typical balance sheet are debt to financial institution, bonds, debentures, mortgages. Moving further, let us now understand the valuation of liabilities. Indian Accounting Standard 29 deals with valuation of liabilities. Liabilities may be valued first at their discounted net values in accordance with the manner of valuing assets in economics. Second, in accordance with accounting conventions, they may be recorded at their historic value, that is, the valuation attached to the contractual basis by which they were created. There is no difference between the two methods of valuation as regards liabilities which are payable immediately, and it is only as the maturity date of liabilities lengthens that the difference appears. While accounting conventions dictate that the valuation of liabilities should be based on the sum which is payable, it is accounting practice to make a distinction between current and long-term liabilities. As regards current liabilities, there is little difference between the discounted net value and the contractual value of liabilities. In this connection, current liabilities are defined as those which will mature during the course of accounting period. The gap between the two methods of valuation is significant as regards long-term liabilities. Long-term liabilities are valued on the basis of their historical value, that is, by reference to the contract from which they originated, and hence during periods of inflation or where the interest payable is less than the current market rate of interest, the accounting valuation will certainly be overstated by comparison with the discounted net value. Let us now recapitulate what we have learned so far. Assets and liabilities are very important aspects of business. Balance sheet is prepared on the basis of them and distinguished between and presents separately current and non-current assets and liabilities. Since it provides essential information about a company's financial condition, if proper valuation is not made, such balance sheet does not provide true and fair information. Also, to calculate the actual amount of profit and loss, proper valuation of assets and liabilities is necessary. Thank you.